What I'll share with you today is how we are trying to navigate the current conditions. As I said, it is a health-driven issue that's led to issues in the markets, and obviously there will be significant implications on global economies because it's been a sudden stop to economic activity. You would see countries' GDP growth moving into negative territory. We will enter into recessions, no doubt. The question is for us, how are we going to escape from this? So moving on to slide 3, in terms of the factors or the guideposts that we're looking at to help us navigate through this situation, we are seeking to handicap what we call the 3 Ps. The first P is policies. This is on slide 3. The second P is profits. And the third P is positioning. Moving on to the slide number 4, which is where we address each of these factors. As I mentioned, we are trying to handicap the 3 Ps. The first P is policies, and policies involves fiscal and monetary policy responses from central banks as well as governments around the world. The second P is profits. These are essentially corporate profits or earnings of companies. And the third P is positioning, how investors are positioned, sentiment levels of investors. Moving on to the first P, which is on slide 4. What we have seen in the past couple of weeks, and it's accelerated in the last few days, is that central banks around the world, the Federal Reserve of the United States, as well as governments around the world, have started to panic. Now, there is a saying in investments which goes like this, and that is when governments panic or when policymakers panic, that usually signals that we are close to a bottom. That holds true most of the time if it's just a standard financial crisis. The caveat this time around is that we are also dealing with a health pandemic, of which the outlook is still currently uncertain. We can't see with any clear visibility when the issues related to COVID-19 would come to pass. Be that as it may, what the policymakers have done in terms of both fiscal and monetary policy is still a net positive. If I could use the example of the global economy and the global financial markets as being a patient who is sick, I think what these policies that have been announced and going to be implemented by central banks as well as governments around the world helps to prevent the patient from deteriorating further, from the patient's health deteriorating further and entering into ICU. Will it help the patient to recover strongly? The answer is no, because we are dealing with a health issue, a pandemic, whereby consumer activities, business activities have essentially come to a standstill in a majority of countries around the world. So while you can do a lot of these things in terms of policies, be it cutting interest rates, injecting liquidity into the financial system, and putting monies in the hands of pockets of consumers or citizens of a country, getting businesses to start activities, getting consumers to go out there and spend the money, discretionary spending, that can only happen once fear over COVID-19 subsides. And that will only happen once there is visibility as to either an infection rate peaking or there is a solution in terms of drugs or a vaccine. So slide number 4 just gives you an example, some data points for you to track. In terms of the fiscal stimulus that has been announced by the G4 countries, these are the US, Germany, China, Japan. They have announced fiscal stimulus amounting to 6.9% of their budgets. And this is the largest ever that has been announced. It surpasses even that was spent during the global financial crisis. This excludes the $2 trillion fiscal stimulus package that the US is currently looking to approve. We just got news that it has been approved by the Senate, and it will be passed back to the House. And if the House approves it, then the US will be launching this $2 trillion US dollar fiscal stimulus package. Now, just to recap, in terms of policies and stimulus is concerned, it prevents things from getting worse. For the financial markets, it permits the financial markets to start operating a little bit more normally. In the last 2-3 weeks, in the initial stages, we saw that the financial markets were dislocated. We saw that even the US Treasuries market was dislocated. Investment grade bonds were trading at very wide bid to ask spreads, and that is not healthy. What we've seen over the past few days after the US and policymakers around the world have announced their measures, we have seen indications of a normalization of the functioning of financial markets, especially in the credit space, in the fixed income space. We've seen US Treasury markets trading more normally. And in fact, we are also very encouraged that in the past 2 or 3 days, we have seen that companies have been able to come up to issue investment grade bonds. 2-3 weeks ago, this wasn't happening. It started to happen already. So there is an element of normalization in the past couple of days. So that is essentially the first P, which is policies. And as I mentioned right at the start, for us in helping us navigate the current scenario, we are trying to handicap each of these factors. And to me, when we are looking at policies and handicapping it, I would put that down as a tick in the checklist. Governments and central banks are doing all they can. They can do a little bit more, but essentially they are trying to implement a lot of policies and arsenal within their capabilities. So that is a positive, and it helps to prevent the markets, the financial markets, from deteriorating further, from going into seizure. Now, moving on to the second P, which is profits. This is very difficult to handicap because some of you on this call are businessmen. People like us, we also continue to engage with the companies, the investee companies that we have invested in. And what we are getting, and to no surprise, is that there is no visibility. A lot of the companies that we track, that we have invested in, or that we keep abreast on, they are not able to provide guidance as to their earnings expectations. If you look at the chart that's currently posted in front of you, you can see that towards the end of last year, second half of last year, and leading up to this year and the beginning of this year, earnings expectations across Asia ex-Japan was being revised up. So that was a positive because ultimately when you invest in the stock market, you're investing in earnings. And if earnings is accelerating, that's always a good time to invest in the stock market. What we've seen of late, given the developments in COVID, is that earnings expectations have had to be revised down. The question is then, has it been revised down significantly? To my mind, I think there's further room for expectations to be revised downwards. But you have to bear in mind that the stock markets and financial markets look ahead, and a lot of these further downgrades in earnings may already be priced in by the stock markets. The challenge this time around is that we're dealing with, as I said, a health issue and the ripple effects of consumer behavior and consumer activity, of business behavior and activity, and we don't know how long the duration of this epidemic would last. So visibility is very little at the moment, and therefore, as far as the second factor is concerned, profits, we find it difficult to establish when a bottom would be. Now, moving on to the third P, and the third P is also something that we use frequently in navigating markets. The third P is what we term positioning. Now, if sentiment of investors generally are already very bearish, it shows that a lot of selling has been done. People have sold out of their positions or sold out majority of their positions. So as you can see on this slide here, on slide 8, this is what we call the bull and bear indicator. As at 19th March, based on this bull and bear indicator, the sentiment indicator has already moved to 0.4, close to 0. What does this mean? It means that investors generally are very pessimistic and they are very bearish. And for us as a fund manager, as I mentioned, we entered into this crisis holding comfortable levels of cash. We know we can never pick the bottom, but given where we are starting from, we are comfortable given the policies that have been announced and given the positioning that we currently see at such extreme bearishness, we are comfortable to start tiptoeing back into the stock markets and into the fixed income markets. You can also see from this chart that the indicator has gone to 0 before, so it can't get any worse, although it can stay at 0 for a long time. But essentially, what we are saying is that sentiment is already pretty pessimistic, and it makes sense for us to start nibbling and deploying a little bit of money back into the market. Moving on to the next slide as well, which is an additional slide on positioning. We also look at historical patterns as a guidepost on slide 9 as to previous financial crises and during these previous episodes where the markets had been sold down or where there had been a lot of outflows and selling from markets. Now, this is a table which shows the outflows of foreign funds, outflows out of emerging markets during these various periods, which you can see in the various rows. And you can see at the topmost row, during this 5-week period ending 18th March, we have seen outflows to the tune of $24 billion already. And that equates to almost 3% of funds or assets under management by foreign investors. And on the rightmost column, you can see that during this 5-week period, the MSCI Emerging Market Stock Market Index had declined by 30%. So no single history does not repeat itself, but history rhymes. So for us, this is never conclusive, but it is essentially a framework for us to determine how much more selling there could be, and if there's a lot more selling or a little more selling, how much more potential downside there could be to the market. And I would like to take you to, for example, in the middle of that table, 3rd June 2015 to 16 September 2015. During that period, which coincided with the period when China was going through some difficulties and announced that they would allow the renminbi to weaken, we saw outflows to the tune of $46 billion, which equates to 6.6% of the assets under management. But you would notice that during that 15-week period, the stock market index only declined by 17%. Contrast that with the final row, the largest percentage MSCI. This was, of course, during the global financial crisis. Very quick, very sharp. There was a 4-week period when fund outflows totaled $6.9 billion, equating to 3.4% of assets under management, but resulting in a decline of 35% in the stock market indices, because I presume a lot of selling was also driven by domestic investors. The message I'm trying to share with you here is that these are purely guideposts, but taking into account this variety of factors and experiences that we have seen in prior episodes, we think that the sell down or the outflows is definitely more than halfway done. I'm not saying there could be no further outflows. In fact, there could be. A lot of it has already exited the market, and that has been reflected in the very, very sharp and quick sell-off in financial markets globally. So to recap on the 3 Ps that we're trying to handicap for policies, the central bank policies as well as government policies, I would give that a tick. We are doing all we can. On profits, there is currently very little visibility if the pandemic passes by and we can quickly restart the economies globally by the middle of summer, then there would be a catch-up period in the second half of this year. But until we are more certain of the visibility of this, it is very hard to make an estimate about profits. So from our position, what we will assume then is we can completely write off 2020. And for us, in determining what and where to invest, we are essentially just looking at 2021 earnings to aid in our decision making. So on the second point on profits, I can't give it a tick because there really is no visibility. On the third point of positioning, I would give it a half tick. So out of the 3, we get 1.5, which means we're kind of sitting on the fence. And that's also reflected in our current asset allocation for the majority of our in-house funds, which are sitting on between, for equity funds, between 30 to 50% in cash, for fixed income funds, about 20% in cash. Okay. But given the 3 Ps, in total, I would summarize and conclude by saying that we are starting to nibble in the market. Certain stocks have come down to very attractive levels, stocks that we are comfortable investing in for now and holding on for the longer term, and which we may have wanted to buy in the past, but we felt it was too expensive. These are opportunities that we are investigating now and have started to gradually deploy monies into. So those are the 3 Ps, but ultimately, what matters most in this situation is COVID-19. Everybody here now claims to be an expert virologist. In our investment team, we have assigned 3 people to focus on developments on COVID-19. So just to share with you some of the things we track, simple things like Google searches on COVID-19 amongst the various countries. We of course track the infection rates, new cases, etc. in all the major countries and regions. And on top of that, we are also spending time, not that we are experts, but consulting and liaising with various counterparties and sources of information to see whether there's any developments on the vaccine front or on the repurposed drugs front. Now, if I can take you to slide 10, we've seen the behavior of markets in past epidemics as well as in the current epidemic, whereby we think that the markets would still suffer from a lot of negative headlines in relation to COVID, especially in the West. This graph here on slide number 10 shows you, it's a schematic chart that shows you the trajectory of infections across the various countries. You can see here that China is already on the path to recovery. We think Korea is next because they have tested well and they have been very strict insofar as the containment measures is concerned. Right? Italy has been ugly, truth be told, but in the last 2 or 3 days, the growth rate of infections in Italy has subsided to single digits, I believe. So Italy is also coming to a point whereby it will cross over into late accumulation and subsequently recovery. Of course, the markets that matter most to global financial markets is what's happening in the US. The US has the benefit, I believe, of a fairly strong health system. Although being a free country and a democracy, containment measures or lockdown measures may not be as strictly adhered to as what we've seen in China or Korea. Be that as it may, based on this schematic chart, based on a model that we track, we expect that the US will need another 6 to 8 weeks before we can see peak infection rates in the US. And essentially, that is the crucial, the most important determining factor for us once we have visibility or with more certainty estimate when this peak infection rate is going to occur in the US, then we will look to deploy monies even more aggressively. Because in our opinion, given the amount of stimulus measures that have been implemented and introduced by policymakers, once COVID-19 subsides, there is a lot of, for lack of a better term, there is a lot of firepower and ammunition, which would lead to a very sharp and quick recovery in financial markets. It will be very quick and it will be sharp. So to recap on COVID, estimates currently suggest another 6 to 8 weeks, and this is something we will continue to monitor. And should the markets come down for whatever reason, to repeat, we are sitting on a lot of cash. We will be looking to average down on existing positions or initiate into new positions.